Good day. My name is Brock Evans, and I'll be covering Scooter's Coffee. This is a managerial analysis of Scooter's Coffee as a whole. So starting out, we're going to be covering the company introduction, the company business model, the contribution margin format and ratio that they may use, the parent process costing method they may use for their franchises, the use of a break-even analysis for Scooters, the margin of safety, the degree of operating leverage, franchise level operating costs or job order costing, and differential costing. Starting with the company, it was founded in Bellevue, Nebraska by Don and Linda Eccles in 1998. The nickname itself is derived from the daughter, who they used to call Scooter, and then a nickname stuck. There has been several expansions of the franchises here in Oklahoma City, with one being on Penn Avenue that I've tried personally, and it is quite delicious. So their brand is a positive attitude. They use the smiley stickers to convey that on their coffees. They also have the brand called Caramelicious, which they have set up. And then their focus is based on their website, seems to be quality, along with some specialty items that you won't see at most places, like a Red Bull, mixed drinks, and teas, and so forth. They do have hot, iced, and blended for their product items for each of those coffees, and that allows the format to be either one of those items, which also adds cost to the price of the coffee minimally because of things like ice, whipped cream, and so forth. So they also have breakfast items that they capitalize, since this is primarily drank during the morning rush. So they do offer those products as well. The flavor of the coffee seems to be smooth, and the actual company itself prides itself by using premium suppliers of roasted coffee beans to ensure a better product. So it's a combination of the quality coffee, the delicious menu items, and their persona that allows their brand to expand. So some of the other aspects of the business is the advent of the franchise. Each location, which can sum an initial startup cost of approximately $400,000 to $700,000 for basically a drive-through kiosk, depending on which cost plan. So they have a high-end cost plan and a low-end cost plan, and those are the two different cost plans that they sell for the franchise owner. So per the website, they also have a royalties fee of 6% and an advertising fee of 2% respectively, which runs them an extra expense in your cost of goods sold during the income statement of 8%, which of course later when we get into degree of leverage would be important, because that adds to your degree of leverage being either too high or too low. So next, the franchises, of course, why it's important, adds an extra income source for the parent income company, but also adds a variable cost depending on sales to the income statement for franchise fee under the cost of goods sold. So also this will have an impact on the break-even quantity. Your degree of operating leverage will also be impacted by this as well. The upside to the franchise owner is why it's lucrative is because there's already an established brand recognition along with the brand itself, and people won't have to go through the process of trying to identify those things, which can add costs up front, making it harder for the franchise owner to punch into maybe a food market that they're looking for. So with that being said, some of the things that I would do if I was running a franchise, or even if I was in the corporate office, is that I'd use a combination of tools. So the first tool I'd utilize is the contribution margin format, which is the actual sales minus the variable expenses and cost of goods sold, which gives you your contribution margin format. From there, that'll tell you, before your fixed expenses, where you're at. So it gives you a better idea. The same thing with the contribution margin ratio is that you find your contribution margin and then divide it by your sales, which would then give you your ratio of what it is you have, your operating expenses in relation to your entire budget. So that's important because you want to know how well you're operating, and that kind of gives you a better idea of your financial health. But it's a starting point, and not by no means, in my opinion, the endpoint to what you need. So with that being said, you would take that information to be able to say, hey, where am I at as the company stands? Now, in terms of allocating costs, I would imagine the parent company or the corporate company does the process costing because they do have homogenous items that they sell, cups, straws, branding items, signs, and so forth, that they would then be able to manufacture, mass produce. And because they can mass produce it, they can then allocate those costs, and their allocation based across the items. And I would imagine because they're each different, so a cup is going to have different cost variables than say something like your powder, which may have people that have to prep the stuff and mix it, and that has different components, and it's perishable. So then you got to look at the aspect of spoilage. So for them, I would imagine they have a multiple predetermined overhead rate that they would then use for each of the products to ensure that they can get a better zero in on how much each of those items cost. So overall, I think the process costing method would make more sense because of the fact that they're in that setup. And with that being said, of course, no matter if it's the parent or the actual franchise, and we'll talk about the franchise later, they both need to make sure that they do a break-even analysis. And as stated by Hayes and Scott in March of 2020, they stated the break-even analysis looks at the level of fixed costs relative to the profit earned by each additional unit produced and sold. So your break-even analysis is to ensure that you can meet your fixed costs, because no matter what, you're going to have these sunk costs that you're going to put into the business, these costs that you're going to have to take care of. Excuse me, not sunk costs, but costs that you have to take into account, and you need to be able to operate. So obviously, if you have utilities, you need to make sure that those are covered, equipment, things like that are going to go into that you're going to have up front, right? And so you want to make sure your break-even analysis, you can at least cover those at a minimum. Now, operating wise, I don't recommend staying at the level. Of course, you want to make sure your profitability is higher. So that's where we'll get into margin of safety and do well as a way to help that. But so as that being said, that first step, this break-even analysis can kind of tell you, how well you're doing, and then maybe you can do differential costing later based off of that. So from there, your margin of safety is the month less of actual sales minus the break-even points. That's why the break-even point in this scenario is important, because you need to know that in order to get your margin of safety. From there, if you're looking for the actual margin of safety, the formula itself is sales minus break-even divided by sales. That gives you what your margin of safety would be for the company. And then as far as it goes, if you want to correct that, so below margin of safety, you can raise your prices on your goods to increase your margin of safety, lower your break-even costs, or increase sales volume. All those increases your profitability, which then, your safety is essentially a range on how well you're operating. So if you're not in a good margin of safety, chances are you could possibly go into the negative. So you want to make sure you do those steps to increase that margin of safety. So it's highly important. With that being said, also operating leverage, as stated by my accounting course, is a financial efficiency ratio used to measure what percentage of total costs are made up of fixed costs and variable costs in an effort to calculate how well a company uses its fixed cost to generate profit. So this one just shows, is my operating effective in relation to my fixed costs? And so how to calculate it is a variable per unit cost minus price times quantity, and divided by the same aspect of the numerator, which is that variable cost per unit cost minus price. So, and then less the fixed operating costs for the denominator. And that gives you your degree of operating leverage. A high degree of operating leverage in this case is a larger fixed cost of variable costs, which means we need to find a way to lean out our fixed costs in order to make sure we're operating. And then your low DOL is a higher variable cost to fixed cost ratio. This may be that your production is not efficient and you are either wasting items or you are not allocating resources adequately. There's something off somewhere and you need to identify that, or you need to change your variables. So it definitely is a good starting point for your differential costing, which I think is important, especially in a company like this that has multiple products. Um, and before we get into that, I want to go into the other side of the franchise. So I think that there's process costing for the parent company, but I would imagine there's job order costing because there's a point of sale the moment you go into the drive-through. You place your order, that goes through a point of sale. That point of sale then essentially sends that over, but each of those orders have different things. So if you have a regular coffee, there's nothing in it, there's no whipped cream, you don't have the extra expense of adding those products or those items to that product. And so I would think the job order costing would be more applicable because also you have to do the worker salaries in there that may or may not be the same at the manufacturing side. And then you have to allocate for those other expenses that you may have to make the additional parts of the drink, plus the fact that you have the differences in what items they order. And so I think that's important. With that being said, like I said before, the differential costing to me, I think, is something they also do because their namesake is Caramelicious. Obviously, Caramelicious is what they sell the best. So for me, if I were to run the company, I would look at that as a standard because that right there, if that's their benchmark or their namesake, there's a reason for it. Obviously, they probably have the higher level of sales and level sales volume for it. So I would go with that as my benchmark and try to see if I can match everything up to that as to be successful. And so, from there, you could look at the capacity of, adding this other item in relation to your manufacturing in the line, and then what costs are associated with it, and why would it be important to either keep it or kill. So that's why I think the predetermined overhead rate is important because if you have the proper costs allocated to the product line, and say you do a test run to see what the revenue was, that would help. So you can decide, hey, yes, this is profitable. This is profitable less all these costs, and it still makes money. And so we would like to add this, or you could have a product that's just not doing well, and you can do an assessment of that. So differential costing, I think, is something they would utilize, and I think it's important overall. So with that being said, we talked about the company itself, that it was founded in 1998. Don and Linda Eccles, and the name Scooter was a nickname for the daughter. The business model of how they're franchises and how they have to pay for the franchise, and why franchising is important because it adds to cost and revenue on both ends of the spectrum. The contribution margin format and why that's important in relation to how the business is a starting point, and so they can see where they're at and go from there. Process costing on how they allocate their indirect and direct costs. Use of the break-even analysis on why it's important because they need to make sure that they can cover the costs from both the franchise to the parent level. Your margin of safety, which tells you how well you're potentially operating and if you can cover your costs, long term. Your degree of operating leverage and how your production mix is to see if maybe you can lean out your fixed cost or if you need to lean out your variable cost. And then your job order costing at the franchise level. And then lastly, the differential costing on either having a product that needs to be removed or keeping a product and or adding a product. So those things I think are all important aspects that they would use in their business model to potentially see where they stood from a managerial accounting perspective. I appreciate your time, and I hope you have a great, fantastic